What I'm going to do is loosely describe what equity analysts do, and I've only got 10 minutes to do it, so it's going to be a bit of a challenge. But essentially, when you're looking at the market and looking at what's going to happen next, and should I buy or sell a stock, is it a good idea or not? Essentially, there are two basic approaches you can take. One is top down, which is known as charting following the crowd, if you like. This many people can't be wrong. The trend is your friend. And in a way, you're just looking at what seems to be happening to a particular stock or an index to get a feel for whether you should buy or sell. Then there's bottom-up investing, which is rolling your sleeves up, looking at individual companies from the ground up and making an investment case, almost standing apart from everyone else and thinking, what do I think? Do I think this is a good company? Do I think it's good value? So I'm going to take those in turn. What is the top-down approach, the momentum-based approach? If you like, the trend is your friend. Well, imagine for a moment, if you will, I'm just going to bring in a prop here. Imagine you were trying to work out what was happening to a share. What you could do is calculate a thing called a moving average. Now, if you bear with me on this primitive whiteboard, what this shows is a share price over 3 days. Really simple share price, closing price for a company, £1, £2, £3. Now, it doesn't take a rocket scientist to realize the average, the simple average is 2. Now, were you to move on a day, drop the day one reading and bring in another day, so 2, 3, 4 are your 3 readings, you'd say the moving average has now moved up to 3. That's just the simple average, the mean of those numbers. If you had readings of, as you can see there, 3, 4, 5, the moving average moves up again. And that moving average is just a 3-day moving average. So it's just using 3 data points. So as such, you might say, well, it's not terribly representative. It could be skewed by big stock movements in an individual trading session, but nonetheless, it would give you a flavor for what's happening to the stock price over those 3 days. And if you plotted that on a chart, you'd have the overall share price movement. Now, 3 days is not a fantastic moving average. What you might want to do is to use a moving average for more like 50 days or 200 days. And this would be a short-term moving average. This will be a longer-term moving average. And what people are doing, imagine this on a chart, is they're saying, well, if the short-term average is moving up through the long-term average, that's quite bullish. Equally, if the short-term is moving down through the long-term, that's quite bearish. And if long-term a share is moving up, but this cuts through it, that could be a sign that things are heading down. Maybe that's downward pressure on the share price. And equally, if you've got a company that's basically moving down on this average and you've got this coming up through it, that will be quite bullish. So people watch what's happening to the short-term moving average versus the longer-term moving average and take that as an indication that they should either buy, ideally ahead of everyone else, or sell, ideally ahead of everyone else. And you get some quite glamorous names given to these things. So when this short-term average on a chart, rather than on post-its, moves up through the longer-term moving average, that can be known as a golden cross. That can be very bullish momentum. Now, there are people saying, well, that's all very well, but all you're doing there is reading lines on a chart or little post-it notes in my example. So isn't that just sort of relying on the market to get things right? It all seems a bit sort of vague and fluffy. So bottom-up analysis or value investing says, no, I'm not going to do that. I might nod to that. I might use that to help me. I might try and read the charts, if you like, a little bit. But fundamentally, what I'm going to do is bottom-up analysis. I'm going to take a company and I'm going to start from the bottom up and make the case for buying it. And what you might do is look at some fluffy stuff, hence the clouds, which is quite difficult to put a number on. So the quality of the management team. This is not worrying about what the share price chart is doing. It's actually looking at the individual company. You might look at the strength of the company's moat, as Warren Buffett called it. Does it have competitive advantage? How easily can competitors get into this share of the market? Are there regulatory protections, for example? Is it quick to scale up a business in this space or quite slow? How loyal are consumers and how quickly could a competitor drag them away? That's called stickiness. But that's all quite fluffy. Allied with that, you might then want to do some number crunching on the company, both its financial strength looking at the balance sheet, its assets, and so on. And also what I'm going to touch on here, which is value for money. Do I want to buy this company? Forget what the rest of the market's thinking. Do I think it's good value? And there are a couple of ratios you can use to help you with that, which I'll come to in a moment. But essentially, what bottom-up value investors are doing is comparing two things. They're saying, let's look at the market value of the company and compare it to what I think it's actually worth. And essentially, if the market's up here, but what I think it's worth is down here, well, maybe the market's priced that a bit expensively, so I need to really think that's a good company. But if maybe we're looking at an intrinsic value like that, then maybe the market's got it wrong. Maybe I'm seeing something, doing my number crunching at home, that the market isn't. So maybe there's an opportunity there. Now, what would I be doing? I mean, what would I be looking at? Well, lots and lots of numbers potentially, but two that get quoted in the press, probably more often than any other, are these two, the PE ratio and the dividend yield. Now, to take those in turn, the PE ratio asks a very simple question. It says, if you buy the share at today's share price, how many times 1 year's earnings is that? So you get a number like 10. Share price is £10. Earnings per share forecast for the next year is, let's say, £1. Okay, that will give you a PE ratio of 10 times. Crudely speaking, a PE ratio of 10 times, ignoring discounting, basically says, if I bought the share at today's price, I'd be prepared to wait 10 years to get my money back in earnings terms. And you might think, well, I would wait 10 years for something, but then how come some technology stocks have got PE ratios of 100? Who waits 100 years to get their money back? The answer is not many investors I know. So a high PE ratio suggests investors are expecting rapid growth in earnings. They're looking to the future. They don't know what the future holds. And they're saying, no, I think this company is going to grow fast. So I am prepared to pay quite a significant premium to get hold of it today, because actually it's not that much of a premium when you look at the company's future growth prospects. But there are other investors who say, no, I'm not interested in those high PE growth stocks. I want solid companies, perhaps with very low PE ratios. So utility companies might have a PE ratio of, say, single digits. I mean, the UK stock market, as the FTSE 100, hovers around, let's say, 12, 13, 14, 15. So there might be companies out there trading on only 8 or 9 times 1 year's earnings. Why are people buying that? I mean, that doesn't sound very exciting. Not a growth company. Or maybe you're looking at a company that's offering a decent dividend yield. So out there, you've got investors looking for growth, investors looking for income, and you've got investors looking for a mix of the two in an ideal world. And there's a trade-off. If you want growth, high PE ratios, chances are you're not going to get much of a dividend out of the company because it's using all its money to grow. But equally, there are companies that don't grow very fast, but do offer decent yields. Now, what's the yield? This is saying if you're an income investor, the company has the option to pay some of its profits back to you every year rather than keeping them to grow. So you could look at what the company pays out as an annual dividend, put it over the current share price, work out a percentage, and that will give you a dividend yield. So this is a number, this is a percentage. And there is a trade-off, generally speaking, insofar as if you want growth, you're not going to tend to get yield. If you want yield, you're not going to tend to get growth. All right. Now, as a bottom-up investor, therefore, you need to decide, what am I after? Am I looking at this company as a source of income? Am I looking at it as a source of growth? And then these are just two of the numbers that start to get you into, is this good value for money or not? All right. In other words, what level of growth am I going to get in the future? And that requires a little bit of crystal balling, if you like, predicting earnings, which is not easy to do, versus how much cash might the company pay back in the future, jam today rather than jam tomorrow. At that point, I'm going to leave you with those thoughts, top down, bottom up. Most equity analysts use a mixture of the two. The balance will depend on the analyst you talk to.